Welcome back to Financial Crime Awareness Hub. We have now covered Domain A, the risk and methods of financial crime, and Domain B, the global regulatory framework that govern the anti-financial crime system. If you have not watched those videos yet, the links are in the description below. In this video, we moved into Domain C. This is the largest and most practical domain in the entire CAMS exam. It carries 30% of the total exam weight, which means 36 of your 120 questions comes from this content alone. Domain C is different from what we have covered so far. Domain A told you what financial crime looks like. Domain B told you where the rules comes from. Domain C tells you what you are required to do about it inside your institution, in your compliance program, with your customers every single day. Because Domain C is so large, we are covering it into two parts. In this part, we'll focus on the customer-facing obligation, risk-based approach, customer due diligence, beneficial ownership, enhanced due diligence, PEP. And in the part 2, we will cover about the program obligations, suspicious activity monitoring, sanctions screening, record keeping, training, the compliance officer role, and internal controls. This video is brought to you by AdviseCube Consulting. We provide practice question banks, concise study notes, and full e-learning course with an artificial intelligence bot trained on certified anti-money laundering exam material. Visit www.advisecubeconsulting.com to see full range. 36%, 36 questions. That is more questions than any other single domain in the exam, tied only with Domain A. But here what makes Domain C different from Domain A. Domain A tests whether you understand financial crime in theory and in practice. Domain C tests whether you understand what your institution is required to do so. This is most operational relevant domain in entire certification. Everything covered in Domain C maps directly to a real decision that a compliance professional makes in their daily life. Who do you accept as a customer? What do you verify? How often do you review? What happens when something does not look right? The exam scenario questions in Domain C are the most practical of all four domains. They will describe a customer, their background, their transaction, their ownership structure, and ask you what is the correct answer. There is no room for vague answers. Either you know the standard or you don't. Master Domain C and you have controlled 30% of the paper. Let us make sure you control it. Before we get into customer due diligence, beneficial ownership, and enhanced due diligence, we need to establish the foundation that underpins all of them. That foundation is risk-based approach. The risk-based approach is not a compliance technique. It is organizing principles of entire global anti-financial crime framework. The FATF mandated it. Every major regulatory framework in the world has adopted it, and every Domain C question is implicitly testing whether you understand it. So what does the risk-based approach mean in the simple terms? It means apply greater scrutiny where the risk is higher. Apply proportionate measures where the risk is lower. No institution can apply maximum due diligence to cover every single customer. That would be impossible. The risk-based approach gives institution a principled, defensible framework for allocating their compliance resources where they are much more needed. The three steps that we're going to cover now is identify, assess, mitigate. Let's look at the first one, identify. What financial crime risk does this institution face? This starts with a firm-wide risk assessment covering the customer base, the product offer, the geographic reach, and the delivery channels. The risk assessment must be documented and must be kept current. The board and senior management must own it. The second thing is assess. How significant is each identified risk is. This involves two dimensions, likelihood and impact. How likely is this risk to materialize? And if it does, how serious would the consequences be? This assessment produces a residual risk rating after taking into account existing controls. The third one is mitigate. Apply controls that are proportionate to the risk level. High-risk customers require enhanced due diligence. Low-risk customers may qualify for simplified measures. Controls include due diligence, transaction monitoring, staff training, and suspicious transaction reporting. And critically, document the rationale. Regulators will scrutinize not just what you did, but why. The risk-based approach is not a one-time exercise. It is a continuous cycle. Identify, assess, mitigate, and then review. This cycle never stops. Customer due diligence is the process of identifying and verifying who your customer is, understand the nature of your relationship with them, and monitoring that relationship on an ongoing basis. There are 3 levels of customer due diligence. Your risk assessment determines which level applies to which customer. Let's look at the first one. Standard customer due diligence. Standard customer due diligence is the default. It applies to most customers unless the risk assessment indicates that a higher or lower level is appropriate. It requires you to identify the customer, verify their identity using reliable resources and independent ones. Identify any beneficial owner of legal entities. Understand the purpose and intended nature of the relationship. Conduct ongoing monitoring and keep records of everything obtained. Let's look at the second one, simplified due diligence. Simplified due diligence is applied where the money laundering risk or terrorist financing risk is considerably low. This might be applicable to listed companies whose ownership is publicly known, government entities, or regulated financial institutions that are themselves subject to anti-financial crime obligations. It can also apply to certain low-risk products such as basic saving accounts or low-value insurance policies. Here is what candidates frequently get wrong about simplified customer due diligence. Simplified does not mean no due diligence. It means proportionate due diligence. Fewer steps, but not 0 steps. You still monitor the relationship for suspicious activity, and regulators will challenge any incorrect use of simplified measures. The burden is on the institutions to justify why simplified treatment was applied. Let's look at the enhanced due diligence. EDD is mandatory whenever a higher risk has been identified, either by the regulation or by the institution's own risk assessment. It requires additional information, enhanced scrutiny of sources of funds and sources of wealth, senior management approval, and increased ongoing monitoring. We will cover EDD in details shortly. The standard is default. Just to remember, standard is default. Simplified requires justification that the risk is demonstrably low. EDD is mandatory when higher risk is identified. The burden of proof is always sits with the institution. The first step in every customer due diligence process is the identification and verification. There are 2 distinct obligations and the distinction matters. Identification means obtaining the information. Verification means confirming that the information is accurate using reliable, independent sources. You cannot verify without first identifying, but identification alone is never sufficient. Let's look at it. How do we verify individual customers and legal entities? The first one is natural persons or individual customers. For individual customers, you must identify full legal name, date of birth, nationality, and residential addresses. You must verify this information using government-issued photographic identification, a passport, a national identity card, or a driving license. Non-face-to-face customers, those who open accounts remotely without presenting themselves in person carry higher risks. Additional verification steps are required. You cannot simply accept scanned copies of documents without compensating controls. Proof of address is typically required separately: a utility bill, bank statement, or government correspondence. Most jurisdictions require this to be no more than 3 months old, and customer information must be refreshed when it becomes outdated or when a trigger event is occurred, such as large value, unusual transaction, or a change in the customer's circumstances. Let's look at now the legal entities. For corporate customers, the identification requirements are more complex. You must identify the full legal name, registration number, registration address, legal form, and the justifications of incorporation. You verify this through the certificate of incorporation, the memorandum and articles of association, and the register of directors. You must also obtain the ownership and control structure, who owns what percentage of the entity, and you must identify and verify all persons who own or control 25% or more of the entity. We will cover this in detail in the next section on beneficial ownership. Where no natural person meets the 25% threshold, the senior managing official of the entity must be identified as the beneficial owner of the last resort. For regulated entities, banks, and other financial institutions, simplified verification of their regulated status must be acceptable, but verification of that regulated status is still required. Beneficial ownership is one of the most important concepts in domain C and one of the most frequently tested. The question it answers is this: behind the legal structure, who actually owns and controls this customer? A beneficial owner is any natural person who ultimately owns or controls a customer or on whose behalf a transaction is being conducted. The standard threshold is 25% ownership or control. Some jurisdictions set a lower thresholds, such as 10% is used in some high-risk context. There are two routes to beneficial ownership. The ownership route: a customer who directly or indirectly owns 25% or more of the shares or voting rights of the entity. This can be through direct shareholding or through a chain of entities where the person ultimately stake exceeds the threshold. The control route: a person who exercises control through other means, such as board influence, veto rights, contractual agreements, or by being the settler, trustee, or beneficiary of a trust. Control does not require majority ownership. A person with the power to appoint or remove the majority of the board effectively controls the entity. Senior management officials: where no natural person meets the 25% threshold, either through the ownership or control, the senior managing official of the entity must be identified as the beneficial owner of last resort. This is a fallback, not an exemption. Let's look at now the red flags in beneficial ownership. Any of the following should be treated as a serious red flag: a customer who refuses to identify the beneficial owner, nominee shareholder, or directors with no apparent business rationale, complex ownership chains that serve no plausible commercial purpose, a beneficial owner who turns out to be a PEP, which automatically trigger enhanced due diligence, beneficial ownership information that cannot be independently verified, and any request by a customer to not to record the beneficial owner, which should result in refusal of the relationship and consideration of a suspicious transaction report. Know both the routes to beneficial ownership. Know the 25% threshold. Know the fallback to the senior managing official. These are the exam fundamentals. Enhanced due diligence is not an optional upgrade. It is a mandatory requirement whenever a higher risk has been identified, and the exam expects you to know both when it is triggered and exactly what it requires. When EDD is triggered, the following situations require enhanced due diligence as a matter of regulatory obligation. PEP and their family members and close associates, customers connected to high-risk jurisdictions, correspondent banking relationships, non-face-to-face customers, complex or unusual ownership structures, and cash-intensive businesses. But the list does not stop there. The risk-based approach also requires institutions to apply EDD to any other customer or relationship where their own risk assessment indicates a higher risk, even if the category is not explicitly mandated by the regulations. The institution's own judgment must be applied and documented. So, what enhanced due diligence actually requires from us? First thing is additional information. A more detailed customer profiling covering occupation or business activities, the nature and the purpose of the relationship, and the expected transactions patterns. This must go beyond the standard information collected at the time of onboarding. The next thing is source of funds. How was the specific money being used in this transaction or relationship generated? A bank statement, payslip, sale contract, loan agreement? The answer must be verified, not simply stated by the customer. Let's look at the next one, which is source of wealth. How did this customer accumulated their total financial position? Business ownership, a career, inheritance, investment returns. Again, verified, not just stated. We'll cover the distinction between source of funds and the source of wealth in the next slide because it is one of the most tested distinction in the entire domain. Let's look at the next item here, senior management approval. Before the relationship commences or continues, it must be approved at senior management level. This is not a formality, it is a deliberate escalation of accountability for higher risk relationship. Enhanced monitoring. Actually, it increased frequency and depth of transaction review throughout the relationship. Ongoing monitoring must be proportionate to the risk level, not set once and forgotten. So everything done under EDD must be documented, the rationale, the evidence, and approval. Regulators will audit this. If it is not written down, it did not happen. This is the distinction that candidates gets wrong most frequently in domain C. It appears in almost every EDD scenario question. Know it precisely. Source of funds. Source of funds is the origin of the specific funds being used in a particular transaction or relationship. It is a narrow in scope, limited to this transaction only, this account, this moment. Example of source of funds include salary payments from an employer, proceeds from the sale of a specific property or business, a loan disbursement from a bank, dividend payments from an investment, or an inheritance received from a specific estate. Source of funds is verified by payslips, bank statement, sale and purchase agreements, loan agreements, or probate documents. Source of wealth. Source of wealth is the origin of the customer's total accumulated assets and net worth. It is a broad in scope, covering the customer's entire financial history and the explanation for their overall financial position. Examples of source of wealth includes successful business ownership over many years, a senior executive career with high compensation, a significant inheritance from a family estate built over generations, an investments portfolio accumulated over decades, or a real estate portfolio developed over time. Source of wealth is verified by business records, audited financial statement, tax returns, legal documentation of inheritance, or professional valuations. Let's understand why both are required under EDD. A customer could have a perfectly clean source of funds for a specific transaction. The money came from a legitimate bank account, while their source of wealth is entirely unexplained. Without verifying source of wealth, you have no understanding of whether the overall financial position is consistent with the legitimate career or business. Conversely, a customer could have plausible career history explaining their source of wealth, but the specific funds entering the account today cannot be traced to any legitimate activity. Source of funds, you can remember that it will be for the particular transaction. Source of wealth equals their entire financial history. EDD requires both and verification of both, not just the disclosure. Politically exposed person are one of the most consistently tested topics across all 4 domains of the exam. Every compliance professional must understand who they are, why they are high risk, and what obligations apply. A PEP is an individual who is or has been entrusted with a prominent public function. The reason they carry elevated risk is straightforward. People in position of public power have greater opportunity to engage in corruption, abuse of office, and the accumulation of illicit wealth. They are not assumed to be criminals. They are recognized as higher risk and treated accordingly. There are 3 categories of politically exposed person. Let's look at the first one, which is foreign PEPs. They are individuals entrusted with the prominent public functions in another country, such as heads of state and governments, senior politicians and ministers, senior judicial officials, senior military officials, and senior executives of state-owned enterprises. Foreign PEPs are always treated as a high risk under FATF standards. There is no exceptions based on the perceived integrity of the foreign jurisdiction. Let's look at the second one, domestic PEPs. These individuals entrusted with a prominent public function in the institution's own country. Members of parliament, senior local government officials, senior central bank officials, leaders of major political parties, and senior public prosecutors fall into this category. The risk treatment of domestic PEPs is assessed on case-by-case basis in some jurisdictions, but many national frameworks treat them as always high risk. Let's look at international organization officials. Senior officials of international organizations such as UN, IMF, World Bank, regional development banks, and major international courts. These individuals carry the same enhanced due diligence obligations as foreign PEPs. Family members and close associates. PEPs status extends beyond the individuals. Family members such as spouse, children, parents, siblings, and close associates such as business partners, personal advisors, individuals known to be closely connected, carry the same elevated risk treatment. This extension is explicit in FATF Recommendation 12 and in national law across most jurisdictions. The exam asks about all 3 categories. Know each one, who qualifies, what the default risk treatment is, and whether family members and close associates are included. Now let's look at the PEP obligations. Understanding who a PEP is gets you halfway. The other half is knowing exactly what your obligations are at every stage of the relationship. Let's look at the first one, identification. Before actually onboarding, you need to do that. So you must screen all customers against PEP database at the point of onboarding. This includes screening the beneficial owners, not just the named account holders. You must also screen family members and close associates where they are identified as part of the onboarding process. Do not rely on customers' self-declarations alone. Customers are not always forthcoming about their political connections, and some may not even realize that a family member's role creates a risk for them. Independent screening tools must be used. The second one is the onboarding. So before you commence a relationship with a PEP, senior management approval is mandatory. This is not a formality. It is a deliberate escalation of accountability. The relationship must be approved by a senior manager, and that approval must be documented with the rationale. Enhanced due diligence is required from the outset. Additional information, verification of source of funds and source of wealth, and a documented risk assessment. Being a PAP is a trigger for enhanced due diligence. It is not an automatic ground for refusal. Now let's look at ongoing monitoring. The obligations do not end at onboarding. Transaction monitoring must be increased in frequency and depth throughout the relationships. Customer profiles must be reviewed at annual basis and more frequently for higher risk relationship. Rescreening must be conducted periodically because PEP status can change as public roles change. Any unusual or unexplained transaction must be escalated immediately. Exit and former status. So this is the area most candidates overlook. PEP status does not end the moment they go off from their public roles. FATF actually requires a risk-based judgment on how long enhanced measures must continue after a person leaves office. In practice, most jurisdictions apply a minimum continued period, often 12 months, and some require enhanced treatment to continue indefinitely where the corruption risk persists. Any decision to declassify a customer as a PEP must be documented with a clear rationale. The default position should always be to continue enhanced treatment until there is a positive basis for reducing it. From the exam perspective, treating PEP status as ending when the public role ends, it does not. The risk-based judgment continues. Customer due diligence is not a one-time event. The onboarding check is the start of the relationship, not the end of the compliance obligation. Ongoing monitoring is the mechanism by which institutions keep their customers' risk assessment current and detect suspicious activity throughout the relationship. The first thing that we need to look at is the transaction monitoring. Every transaction must be assessed against the expected profile established at the time of onboarding. What did the customers say they would use this account for? What transaction volume and patterns were expected? Any transaction that is inconsistent with that profile in terms of size, frequency, origin, destination, or nature must be flagged and reviewed. Key patterns to monitor include such as structuring, multiple transactions deliberately kept below reporting threshold, unusual geographic patterns such as payments to or from high-risk jurisdiction, transactions with no apparent business rationale, and sudden significant changes in transaction behavior. Automated transaction monitoring systems can generate alerts, but a human being must review each alert and make a decision wisely. The decision must be documented. An alert that is dismissed without a recorded rationale is a regulatory failure. The second thing that we need to look at is the customer profile review. The frequency of customer profile reviews depend on the risk rating. High-risk customers, including PEP and customers connected to high-risk jurisdictions, must be reviewed at least annually and often more frequently. Medium-risk customers are typically reviewed every 2 to 3 years. Low-risk customers may be reviewed every 3 to 5 years. Trigger-based reviews are equally important. A large or unusual transactions, adverse media coverage, a change in the customer's circumstances, or the reactivation of the dormant account. Any of these must trigger an out-of-cycle reviews regardless of when the last scheduled review occurred. Record keeping during monitoring. Transactions records must be kept for a minimum of 5 years from the date of the transaction in most of the jurisdiction. Customer due diligence records must be kept for 5 years from the end of the customer relationship. Records must be sufficient to reconstruct the transaction if required by authorities and must be available promptly on request. Records cannot be destroyed while a suspicious transaction report is pending or while an investigation is underway. Part 1 of Domain C covers 4 major topic areas. Here's the study structure that will make them stick. Phase 1. Know the 3 levels of customer due diligence. Draw a simple table, 3 columns: standard, simplified, and enhanced. For each column, write down what triggers it and what it requires. This single exercise will anchor the framework in your memory more effectively than reading the chapter 3 times. The key discipline is understanding the burden of proof. Simplified requires you to justify that the risk is demonstrably low. Enhanced is mandatory when higher risk is identified. Standard is default when neither applies. Know which way the burden runs. Phase 2. There are 4 distinctions that appear repeatedly in Domain C scenario questions. Source of funds versus source of wealth. This distinction appears in almost every high-risk customer question. Identify versus verify. Obtaining information and confirming it are separate obligations. PEP, domestic versus foreign. The risk treatments differs, and politically exposed persons, current versus former status. Enhanced obligations continue after the public roles ends. Practice such kind of scenarios, it articulating each distinctions in one sentence. If you cannot explain it clearly and briefly, you are not ready to apply it under exam pressure. Phase 3. Practicing the questions. Every Domain C question gives you a scenario. A customer approaches the bank. Here is their background. Here's what they want. Here's the transaction. What you do. Your discipline when reading these questions must be identify the risk indicators first. Who is this customer? What category do they fall into? What products or services is involved? What risk level does the trigger? Then apply the correct level of due diligence and identify what specifically it requires in this scenario. Practice until classifications becomes automatic. This is what the 1700 practice questions at AdviseCube Consulting are designed for. It will help you to understand different scenarios and practice rigorously. Before we close part 1, let me tell you about what AdviseCube Consulting has built for candidates. Preparing for the certified anti-money laundering exams is a crucial thing. The practice question bank has over 1700 scenario-based questions across all 4 domains. Domain C questions are also built around realistic customer scenarios, the same format you will face on the exam day. They are not definition recall questions. They require you to apply the framework to a situation and make a compliance decision. That is the skill the exam tests, and that is the skill the questions build. The concise study notes cover the material across multiple financial crime certifications, written for working professionals who study around a full-time career. No padding, no unnecessary details. Visit advisecubeconsulting.com to see the full range of certifications covered. And the important thing that will help you during the preparation of CAMS exam is the full e-learning course, which is available on our third-party platform called CourseBox, which has a bot which is purely trained specifically on certified anti-money laundering specialist exam. Ask it about the difference between the source of funds and source of wealth. Ask it about a PEP. Ask it about the life cycle of a PEP. Ask it about a 25% beneficial ownership threshold. It will give you an accurate and immediate answer at any time of the day wherever you are. You do not need a trainer anymore. You are free to study any time of the day. Visit AdviseCube Consulting or send us a WhatsApp on the given number or email us at info@advisecubeconsulting.com. This is part 1 of Domain C, the risk-based approach as the foundation. The three levels of customer due diligence: standard, simplified, and enhanced. Customer identification and verification for both natural person and legal entities. Beneficial ownership, the two routes, the 25% threshold, and the fallback to the senior managing officials. Enhanced due diligence, when it is triggered and what it requires. The critical distinction between the source of funds and source of wealth, and the full politically exposed person's life cycle, identification, onboarding, ongoing monitoring, and the obligations that continue after the public role ends. If this video helped your preparation, please like it. It helps other candidates preparing for the same exam find the same content. Subscribe to Financial Crime Awareness Hub. Part 2 of Domain C is coming next. Suspicious activity monitoring, sanctions screening, record keeping, training obligations, the compliance officer role, and the internal controls. That content is equally important and equally tested. Leave a comment which part of part 1 was most useful for you. Source of funds versus source of wealth, PEP life cycle, beneficial ownership. I'll read every single comment and revert back to you. And if you are ready to practice what you have just learned, AdviseCube Consulting is there to help you. Visit us at advisecubeconsulting.com and apply for the practice exam questions. I'll see you in part 2. Thank you so much.